Welcome to step 3 of 5-step trading FX. So far in this course, you've learned about the history of money and the basics of the FX market. We have discussed the importance of economics in the value of currencies. And we have come up with a number of trading ideas. Here in step 3, we will analyze these ideas from a more technical angle. And that means looking at currency charts. In 5-step trading FX, we use charts only after we have put our trading ideas through rigorous fundamental analysis. Charts can show that it might be better to stay away from certain ideas in the first place. But they can also show good entry points for our ideas, and when a trade might not be working and should be taken off. Charts also provide a historical perspective of where a currency has traded in the past. They help me understand the big events and the economy of a country over time. So charts are a really important part of my analysis, and without them I would find it very difficult to trade. And this is why I want to discuss them here. Welcome to step 3 of 5-step trading FX. In 5-step trading stocks, we discussed that considering stock charts before you trade is very important. In currency trading, FX charts are even more important because so many FX traders don't really bother with economic fundamentals. They mainly use charts to try and find patterns that are supposed to predict the future FX price. Because so many traders use charts as their main reason for trading, it's very important for you to know what these traders are looking for. Because when a lot of people do the same thing at the same time, the outcome can often become self-fulfilling. If everybody expects the currency to go up, then everybody will buy that currency. And it will indeed rise in value, because there are so many buyers. So charts are not only a reflection of the economy, they are also a reflection of the psychology and behavior of currency traders. There are thousands of books that teach what they call technical analysis. But just as I have done in previous modules, I want to keep it as simple as possible, so we don't get bogged down by minute details. Let's start with trading idea 1. Short the Australian dollar and long the US dollar. This is the 5-year chart of the Australian dollar versus the US dollar. The Aussie dollar has strengthened significantly. At the start of 2009, you could buy 1 Aussie dollar for only 65 US cents. But in 2012, you actually need more than 1 US dollar to buy 1 Aussie dollar. Let's also use this chart to go through some basic technical analysis terminology, for those of you who are not that familiar with looking at charts. You can see here that between 2009 and 2010 the Aussie dollar was going up, and from 2011 it has stayed at around the same level. We call that an uptrend, followed by a trading range. During the Lehman crisis in 2008, the Aussie dollar entered a downtrend, but most people have forgotten about that. Another way we commonly plot this is through the use of trading channels, such as those shown in this chart. As you can see, each channel covers all the prices within its own time period. You can see that the range over the last year and a half has been 0.97 to 1.10. If your trading strategy had been to buy the Aussie dollar and sell the US dollar at the bottom of this range at around 97 cents, and to sell this currency pair near the top of the range around 108, you could have done this quite a few times and you would have made a nice profit. We call the level at the bottom of the range support and the line at the top resistance. Support is really the level where a lot of buyers come in and the price does not trade below. That of course is a good entry point if you want to go long. The more people who see this support line and the more often it is tested and holds, the more important the level becomes. Of course, you don't want to sell near support unless you think that for some reason this support will break. The same for resistance. You don't want to buy near resistance because a lot of traders are waiting to sell there. Just think of the Swiss Central Bank, which does not want the 120 level of the euro versus the Swiss franc to break. So 120 is a massive support level on the Euro-Swiss chart. Clearly, trends and ranges don't last forever, as we saw on the Aussie dollar chart. And what was resistance in 2008 actually became support in 2011, as we see here. The main reason why the 2008 resistance became support in 2011 is because it was the previous high. And other traders see this as an obvious resistance point, so it stands out on the chart. and every single trader in the world will see it and think it might mean something important. This is very much an example of trading psychology, as we will discuss in step 4. The fact that the high of 4 years ago is still relevant today shows the importance of not only looking at a very short-term chart, but also at the longer-term charts, in order to be able to see the bigger picture. For the purposes of our trading ideas, we want to know what a good point of entry will be if we were to go short the Australian dollar to buy the US dollar. But we also need to figure out a level on the chart where the chart is telling us that we might be wrong. A point at which we would have to unwind our position and take a loss. This point is also called our stop loss or cut. And on the last note, the charts can also help identify possible targets for our ideas. Let's look again at the Aussie dollar. The range is between 0.97 and 1.10. Currently, we're trading right in the middle of the range at 1.04. This is not an ideal point to sell. Ideally, I would want to wait a bit and see if it goes back up to 106 or 107 before selling. But I'm also worried that the price will not reach 106 again, but instead go straight down and break the bottom of the range, and maybe even go down as low as 0.80. So while I waited for that 2 extra cents, I could end up missing out on a 24 cents profit. The logical place to put my stop loss and cut my position is above the top of the range, let's say 111. That is, because once resistance has been broken, it might become a new support level, as we have already seen, and enter a new uptrend. If you remember, I wasn't convinced about this trade in step 2. Having seen the chart and such a simple stop so close to the current price makes me think that the risk reward of selling now is not too bad. Combining this with the chart we will discuss later in this module, my decision is to short the Aussie dollar right here at 1.04. So whilst looking at the first trading idea, we've learned some technical terms, and I have also decided that I want to be short the Aussie dollar versus the US dollar at the current level with the stop loss at 111. We will use this information in step 5, when we need to decide what size this position should be in the portfolio. Let's continue with trading idea 2. Short US dollar, long Indian rupee. First, let's take a look at the long-term chart. Here we see the number of rupees in 1 US dollar. 2 years ago there were 50 rupees in 1 US dollar, now there are 56. That is not what you would expect, given that it's such an emerging economy. It does prove our fundamental analysis though, which did not look particularly good. But the idea here is to find a level at which we think that the price might be telling us that the fundamentals are changing and where we need to do our fundamental research again. Just looking at this chart tells me that 50 is a big level to watch. This also makes sense from a psychological perspective, as traders are attracted to big and round numbers. So, I will add the Indian rupee to my trading screen and will do further work when it hits 50. As a stop loss level, I'm thinking 57. Moving on to the third trading idea now. The Peruvian new sol versus the US dollar. This is the long-term chart of the US dollar versus the Peruvian new sol. You can see that the dollar strengthened between 1992 and 2000. $1 was worth 1.5 sols in 1992, but by 2000 there were as many as 3.5 sols to $1, so the sol weakened significantly over that period. The new sol has now been strengthening for the last 10 years, so something good is clearly happening in Peru, which, as we said before, could well be related to the uptrend in the gold price over that same period. This chart focuses on the past 5 years and shows more clearly that the 2008 level of 2.7 new sols to the US dollar has been broken, which technically speaking is a good sign. The dollar is currently at the upper half of the down channel, which is not a bad entry point into the trade. The stop should be put just above 270, let's say at 271. Our target can be seen from the long-term chart and might be around 220. So our entry is 261, our stop is 271 and our target is 220. I know this is quite a crude way of working, but for now I want to keep it very clear and very simple. And on we go to trading idea 4. Long Singapore dollar, short US dollar, or in proper currency terms, short US dollar and long Singapore dollar. You can see here that since 2002 the US dollar has weakened against the Singapore dollar, from 1.8 Singapore dollars to 1 US dollar to only 1.25 Singapore dollars to 1 US dollar. The big levels right now are 120 as support and 130 as resistance. Just as with the Australian dollar, it's pretty much in the middle of the range. So I'm just about okay to trade here and sell the US dollar against the Singapore dollar at 125 with the stop at 131. But let me see if I can draw any other conclusions from a shorter term chart. Here's the 1-year chart, and now I can actually see that the real levels are really 123.50 and 131.50, and I'm currently in the lower end of the range, which is not a great area to sell. So what I'm going to do is wait and watch to see what the currency will do. If the US dollar goes up versus the Singapore dollar, I will sell US dollars around 129 with a stop at 132. The 129 level is just below resistance, and I expect that many other traders will use this area to go short US dollars. But if the US dollar weakens, I will wait for it to break support at 123.50 and sell it at 122, with a stop around 125. The bottom line is that I'm going to wait a little before buying the Singapore dollar to get the odds on my side. My targets are not quite clear, but levels of 110 and 1 seem like nice round numbers to focus on. And on to trading idea number 5, long Australian dollar and short the Japanese yen. If we look at the Australian dollar yen over the last 3 years, then we see a pretty tight range. In this chart, there are about 81 yen to 1 Australian dollar. Even though it has traded in a tight range, don't forget that you would have picked up a return of about 3% per year because of the interest rate differential. Again, always remember to check the interest rate levels at your broker before you do a trade, and especially before you do a carry trade. I don't think the level is amazing right now, because once again it's in the middle of the range. But I will put on half a position here at 81, because I do like the 3% yield this trade pays when the price doesn't even move. The other half will be executed if it trades back down to 77 or breaks out through 90. My stop will be 73. My target is not quite clear, but the main goal here is to pick up yield. So as long as I don't get stopped out, having a price target is not my main concern. And now on to my last trading idea. Long Mexican peso and short South African rand. This is what the 20-year chart looks like. A pretty volatile currency crosspair. The way to read this chart is that 1 Mexican peso is currently worth 0.63 rand. Clearly, there has been one massively important level here over the past 5 years. And that level is 0.6 rand to a peso. So for our purposes, I'm very happy to go long now at 0.63, since the Mexican peso has broken through resistance and seems to be starting a new uptrend. My cut will be at 0.59. My target is at least 0.75 and potentially much higher. So that completes the process of finding entry points, stop losses and profit targets for my trading ideas. I now want to spend some time discussing a few more technical indicators that might come in useful when trading currencies. When we looked at technical indicators in 5-step trading stocks, we used volume as an important indicator. High volume gives evidence and credibility to price movements. If the price of an asset goes up on low volume, it means there's no real conviction behind this move, and the price could easily reverse down again. Unfortunately, the FX market doesn't have a central register that counts the traded volume. That's because currencies trade all over the world, and no one can keep track of all those transactions. However, the Commodities Futures Trading Commission in the US, also known as CFTC, releases a weekly report that's important to look at before you execute an actual trade. This report can be used to obtain the net balance of the long and short currency futures positions of what they call non-commercials, or, in simpler terms, the currency positioning of the large speculative traders in the market. The basic idea is that if the largest currency traders are very long, then there are not many remaining buyers left, and the currency probably has little upside potential, at least in the short term. And if there's a big short currency position, then the currency might find it hard to go down, because everybody has already sold, and the next trade is more likely to be a buy order. The positioning of these currency traders can be very important for short-term price movements, and I always look at them before I trade. I advise you to do the same. Here you can see the positioning of large futures traders in the euro. They are positioned short 124,000 contracts, betting on the euro to go down versus the US dollar. They are not as short as a few months ago, but still pretty short compared to the past 5 years. As I just mentioned, whenever there are huge shorts, we might be in a consensus short position, where everybody is negative and expecting the euro to fall. But if that is the case, and everybody is short already, again, there's nobody left to sell, and the risk of a reversal of the euro has risen significantly. If that reversal does indeed occur, it can happen very quickly. This is also called a short squeeze. Here I'm plotting the net positioning over the euro chart, with the euro in yellow. You can see the short squeeze here in mid-2010. The market positioning in white was a good leading indicator for the actual direction of the euro. The best way for you to use this indicator is as a warning signal. If you have come up with a great currency idea, but everybody else is already positioned that way, you might be better off waiting. But it can actually also work in your advantage. Here is the current positioning for the Australian dollar versus the US dollar. You can see why the Aussie dollar has been so firm, despite the world economy not being in great shape. It is because so many traders were short and had to cover their positions, pushing the price back up. When I mentioned in step 2 that I would show you a chart that might indicate that this could in fact be a good time to go short the Aussie dollar, this was exactly why. Most other shorts will have cut their position, and traders are now in fact the longest they have been in 5 years. Not a bad time for me to sell the Australian dollar as a contrarian trade. Let's quickly look at the positioning for the yen as well. It's in the middle of the range, so there are no warning signs and no real conclusions to draw. The reason I did not show this before is because I wanted to keep things really simple. But in practice, you always need to look at the net positioning of the professionals before you actually trade. Some brokers will offer their clients a similar product to the CFTC. It's based on the positioning data of all their own clients. The idea is the same here. If the majority of clients are long, it might be time to sell or even go short. If you go to my website, you might see some recent examples of this. The last technical indicator I want to talk about is sentiment surveys. These are questionnaires that ask how bullish certain people are about different currencies. While the previous positioning indicator was based on actual transactions, this one is based on sentiment. Here's an example of one such sentiment survey. The table shows the number of bulls between 0 and 100 for a number of different currencies. A company called Consensus Inc. from Missouri draws from an extensive mix of both brokerage house analysts and independent advisory services to compile this series. It appears that a lot of the people surveyed are bullish on the Canadian dollar right now. This can again be looked at as a contrarian indicator and would make me think twice before buying the Canadian dollar. In the workbook, I will give a summary of many other technical terms that are used in 5-step trading stocks, such as Japanese candles, head and shoulders and double bottoms, which could potentially benefit your analysis as well. For those of you who want to know more about technical short-term trading, I have put together another module that teaches a number of different ways of using technical indicators to trade. This is what is sometimes referred to as trading setups. In there, I will explain the methods used by the famous turtle traders and also the so-called Ichimoku clouds and many others. Let's now go to step 4, where we enter the mind of the trader.